Good afternoon, everyone. I know there's people from across the country, probably in Europe as well. We have over 300 investment partners and potential partners who've registered to be on the call. So welcome and thanks for spending your time with us. My name is David Scherer. I am the co-founder and co-CEO at Origin Investments. Specifically at Origin, my job is to find, analyze, and execute multifamily investments. And I work with a really talented team of acquisition officers and analysts on the investment side, as well as in the investment management side, a separate team that execute all the business plans that are brought to us by our talented acquisition team. So I have two teams that I partner with to both find and execute all these deals. And of course, along the way, we have to manage risk. And we're going to talk a lot about that. Thank you for your questions. We had many questions, about 24 that were emailed in prior, and a lot of them were about risk management, specifically about interest rate management, but there's more to risk management than just that, and I'm going to go pretty deep into that today. So thank you for those questions that you sent in. Growth Fund 4 is actually Origin's 8th fund. I know that's a little bit strange, but Origin does all multifamily. It's all we do, but we do it across the risk spectrum. So Growth Fund 4 is an opportunistic fund. It's focusing on development, but we also have funds that are income funds or they're dividend funds, all provided by multifamily. So all we do is multifamily, but we do it across the risk return spectrum. Growth Fund 4 being Origin's 8th fund. The important thing here is you have over 10 years of audited financial data that will show you the type of manager and the type of returns that we provide. And I really believe you should do your diligence and look at that. It's my belief that the most important thing you can do as an investor is manager selection. It'll be the difference between a 10% return and a 20% return, or it'll be the difference between you taking way more risk that you're not aware of, and oftentimes than maybe you should. And so please do your homework on Origin. And it's my belief, and we'll talk about this today, but it's my belief that the more homework you do, the more you'll decide that Origin is the right choice. And that's why we're so committed to transparency. We want you to learn a lot, and we think that that will result in you becoming a partner at Origin. Once I go over a little bit about Origin and the investment strategy on this particular fund, Growth Fund 4, that should take about 15 minutes. I'm then going to turn it over to Tom Briney, who's going to go much deeper into our deal pipeline, as well as focus on specific deals that we already have seeded the fund with and we're in pre-development on. What's important here is there's two really big benefits to Growth Fund 4, and Tom will elaborate on this. Number one is we're going to invest your money quickly because we've actually been working on sourcing and the business plans of this fund for the last 12 to 18 months. And so we really wanted to get way ahead on that side before we started the capital raise. Because we have so many investment partners, and I think most, or if not all, regard us pretty highly, we're pretty confident that the capital will be raised quickly. And in fact, it is being raised quickly. We launched, I believe, in January and had a very, very strong last 30 days. But the two benefits, number one, you'll get your money invested quickly. And then number two, a lot of these deals were tied up 12, 18 months ago. And meaning when we tie them up, they're tied up at a price. And so a lot of the land that we have that seeds this fund, we both bought far below the market, 20 to 40% cheaper than you would have to buy the land today. And then more importantly, we've done work in entitling the land. And so that we've received more density, we've received the ability to get the things done we need to produce the incomes that we believe will substantiate the returns. A little bit on Tom, because I'm not going to introduce him later. Tom has been with Origin 11 years. I believe he joined us in 2011. Is that correct, Tom?
Yes, sir.
And prior to Origin, Tom was at Blackstone. It's my belief that Tom is one of the premier acquisition officers in the country. He lives in Denver and runs our Western operations. So the target markets we have in the West, which are relevant to this fund, would be Denver, Phoenix, Salt Lake, and Vegas. So he's covering all those markets. Tom has been prolific in sourcing many of the deals in all of our first 7 funds. But much more importantly, the returns on his deals have been extraordinarily high. And he's a big reason why we're a top decile manager of global real estate. And I'll go into more detail on that in a moment. So a little bit of housekeeping before I get started. Lots of investment partners, I said, over 300 on the call. If you're new to Origin or these webinars, we answer questions in real time. We'll probably do 20 to 30 minutes of Q&A. So please be interactive and use your Q&A feature on Zoom. I know everyone knows how to do it. We're going to answer every question. The only reason we wouldn't is we run out of time. We're, again, committed to transparency. So with that, let's get started. So my job here is to tell you a little about Origin. And if you are an Origin investor, bear with me, I'll be very quick on this. The thing that I want to highlight is we're a top decile fund manager. And I mentioned that before. And what's funny here is there's a footnote. You see it, and at the bottom in small print, it explains what that means. And typically footnotes are boring. I actually think it's really important, the footnote. We were actually number 11 out of 274 global real estate managers. So we say top decile, but the reality is we're top 3%. We just think top decile is easier to say and digest. In fact, we're much further along than that. And then what's also as important is this is not for a particular fund. It's a weighted average across 33 realized deals since 2014. And I'm really proud of that because, like I said, we have 8 funds, but this ranking is actually encompassing everything we do. And so I'm really proud that our team's been able to produce that. Now, the 210 equity, average equity multiple and 24% average gross IRR, that's again just corroboration of the top decile or top 3%. How did we get there? A lot of the deals that we do very, very well. In fact, the average has been 24% over a very long period of time. So we're proud of that. In terms of risk management, we'll get to the why, but 0 realized losses, and that's really important. So most of our returns tend to bunch around 15 to 25%. We have no losses ever at Origin, and that speaks to our risk management. And risk management starts with selecting the right deals, and then executing the business plans at a high level, and always paying attention to risk. And I'll get into something I did this morning that would speak to that, the risk management side. 60 million of capital invested by principals. So in the beginning, that was just myself and my partner, Michael Episcope. But the reality is Tom Briney's my partner now. Dave Welk, who also is one of the best acquisition officers in the country, he's my partner now. And so we have lots of partners at Origin, and the bulk of the 60 million is me and Michael, but increasingly our whole team, we're investing in our funds, and we're investing in our funds because we believe it's the best place for our own capital. And it's served us very well for the last 10 years. We've benefited from being able to grow and protect our capital. In terms of investment partners, we have 2,400 active investment partners. That means they're in one of our 8 funds, or they were in one of our 8 funds. Our first fund is liquidated at this point, so they participated in that fund, for example. Increasingly, we have many more registered investment advisor partners as well. And there's probably quite a few registered investment advisors attending this webinar right now. So as we sit today, we have 50 approved investment advisory firm relationships. And what that means is they approve us as a firm and as a fund, and then they allocate their clients into our funds as they see fit, if they fit their clients' portfolios. And so that's a very fast growing part of our business. And then 1.4 billion of assets under management. Candidly, this number will double in the next year because our developments, we don't include in this until they're capitalized and underway. But probably a better measure is we're $1 billion of equity under management. So as we sit today, we have $1 billion of equity to be managed on behalf of our investment partners and obviously our own co-investment. In terms of this fund, my partner Michael and I, as well as the Origin team, will be investing $5 million into this Growth Fund 4 as well. So we'll update that when that happens. Next slide, please. So Growth Fund 4, let's focus right in on this. Growth Fund 4 will be exclusively multifamily development. Origin is an expert in multifamily. We've been doing it for the last 12 years, but this fund will be exclusively multifamily in our target markets. We have lived and worked in the cities that we target, which are essentially the Southeast, Texas, and the Southwest for the last 12 years. And Tom will speak to that. He has been living in Denver, I believe, for 4 years now. What that does is it deepens your relationships with the ecosystem and the market and deepens your knowledge in a way that if you were flying in and out of markets in a day or even in a week, you'll never get that level of knowledge and granularity. The target net multiple, net equity multiple, is a 1.7 to 1.8. That is over 4 years, and that equates to a 14 to 16% net IRR. I want to just make sure that people understand the difference between net and gross. Net means after all management fees and all promotes are taken, and that's what's returned to you. So for example, to make it very real, if someone invested $1 million, we believe that after 4 years, you will be returned 1.7 million to 1.8 million. The first million would be the return of the capital you invested. The second 700 to 800,000 is the return. That return equates to a 14 to 16% IRR. And that's in the investable period. The reason we believe that we can do that in a 4-year period is because we've actually been working on this fund for the last 12 to 18 months, and you benefit from all of that work. We have a very deep deal pipeline that Tom will go over. So the key benefits, you're getting opportunistic returns. If I equated these returns to gross, you generally add 25%. So a gross IRR would be 17 to 20%, a gross net multiple, et cetera. We always quote in net because that's the most transparent way to do it. That's what you receive. That's your return. So we like to do it that way. Diversification means you're not investing in one asset. You're going to invest in 10 to 15 assets. You're going to have geographic diversification. You're going to have, to some extent, vintage diversification. And we believe that we have competitive advantages throughout. We believe we have competitive advantages in sourcing, through relationships in our markets, repeat business, execution, risk management. So what we want to do is exploit those competitive advantages by doing 10 to 15 deals. If you do 1 or 2 or 3 deals, you might not feel that full competitive advantage. And then the optional hold period, and that segues into the next slide, please. So this investment gives you the option. It gives you the option of, you can get completely taken out after 4 years, and then you will receive a much higher IRR. That's that 14 to 16 net target IRR. Or you can take the option to stay in the fund. Now, why would an investor want to stay in the fund? Well, one reason is you're going to get, in the optional period, 7 to 9% net distributions. You're going to get 1 to 2% appreciation. That's pretty conservative. Real estate is appreciated by more than that historically. And the summation of that is the 8 to 11 net annual return. So net of fees to you. The reason that you would want to stay in is it's incredibly tax efficient to stay in. And let me back up for a second. Yes, we have 2,400 investment partners. Every single one of those partners is taxed. And so all of us have the same goals. We want to generate high returns, high risk adjusted returns, and then we also want to shield ourselves from taxes. So during this optional hold period, if you decide to stay in, again, that's completely your option. You will have the benefit of depreciation. You'll have the benefit of interest expense, all set against distributable income. So when you're getting 7 to 9%, it will come with no taxes. And that's really interesting, all right, as a tax investor, is to be getting cash flow, but you don't have to pay taxes because it's being offset. And then if you just look at the appreciation over the next 4 years, it's pretty significant. I mean, you can get out with a nice return, 250 becomes 450, and that's a significant return. But if you keep looking out into time, the compounding of money is a very, very powerful force. And it's one that you should consider. I would just say that one of the mistakes that I made as an origin investor, and a lot of people on this call will agree with this, we did really, really well in Fund 1. You know, it was a 29% net IRR fund. Lots of wealth was created. And then we sold all the assets and we all paid capital gains. And you know what we did with the money? We invested into Fund 2, post-tax. And so once you start thinking about real wealth creation, real wealth is created by building high quality assets at a huge margin, which we're doing, and then operating those over long periods of time. And that's how you get 250 to become $1 million, is you actually stay in, and it's much more tax efficient. Next slide, please. So this slide actually I added when I saw that half of the 24 questions that came in were some iteration of borrowing and hedging strategies. So thank you. This is an example of a lot of questions were sent in, and I responded to it. The short answer to the question which kept coming in is, what are you doing about inflation? What are you doing about interest rates? That risk, you know, we're a risk manager, right? We're not just an investment manager, we're a risk manager. The answer is all of these things. And so I'm going to touch on them briefly. We could spend a whole webinar, and probably we should. But we are executing swaptions. We did 250 million for one fund this morning, and 120 million for another fund, QZ1, Income Plus Fund. If you're in these funds, this was executed today. Goldman Sachs is our counterparty. A swaption is an option to convert to a swap at a future date. I know that's a lot to process, but the point is we are hedging interest rates for 10 full years. And the reason we have to execute a swaption is during the construction period, almost all debt is variable. So you borrow at a variable rate, typically from banks, but others as well. And those lenders do it at variable rates. So if you want to convert that to fixed rate, which we do, there are a few ways to do it. One, you can execute a swap, and we have. We're executing swaps. Think about that as a future. It's an asset if it goes up, it's a liability if it goes down from a strike price. A swaption is an option. It's not an obligation, it's an option. And it correlates to a swap if you exercise the swaption. A HUD it's a government agency. And so we're also looking at executing development HUD debt, which is fixed, and then it stays fixed for over 30 years. So it's extraordinarily long dated, and we're going to be using that in this fund as well. And then Freddie Mac. Freddie Mac will be our preferred lender as we move from variable to fixed debt. So if you think about if we execute a swap or a swaption, we will be getting out of the swap or swaption as we move to fixed debt with Freddie Mac, if that's that strategy. But the point is, the question really was, what are you doing to manage risk with interest rates? And we can go a whole hour on this, and we probably should, but the answer is we're doing a lot. And the reason we're doing a lot is we have huge competitive advantages at Origin. So why wouldn't we lock them in? Why wouldn't we say, you know what? We're really good at finding deals, executing deals, creating margin. Let's fix our interest rate and make sure we lock the whole thing in. And so we are. I mean, that's the short answer. And I would challenge you to have other managers answer this question as well. Next slide, please. Oh, Tom, that's it. And I'm not really that over.
No, this is our development experience, Dave. Keep going. Pipeline's still coming.
Okay. I guess I'm still. What? Give me a time check then.
20 minutes.
I'm 20 minutes in. Okay.
Put your jogging shoes
5
on.
minutes.
Yeah.
So development experience, still me. We have done development in Origin Fund 2, Origin Fund 3, Income Plus Fund, QZ1, and QZ2. This is our 6th fund with development, to give you an idea of the breadth of our experience. This pipeline only includes what's happening in other funds. We're not including this fund's pipeline. Tom will go into that. And then more importantly, I talked about this when I talked about Tom earlier, as a professional. He's prolific in finding great deals, and you see it from the deal's returns. So the 33.7, that's a gross IRR. So again, this is actually before fees. But on a net basis, you would take 25% off of that. In other words, we've done extraordinarily well on our developments. These are realized returns from some of our legacy funds. And I will also tell you that we have 2 more developments that one will be sold. We have call for offers. It's a Fund 3 development next week, actually. And the other will most likely to be sold in the spring. Both in your market, Tom. You source both of them, Connect and Longmont. And both of those will raise this realized gross IRR figure significantly. And so like what will be amended in the future in this deck will be a higher number than what you're seeing. So again, we've done a lot of development. We've also done very well on the developments that we've realized. Next slide, please. I mentioned where we invest before, and that's highlighted by the blue. Texas, the Southeast, the Southwest. That's not by accident. We've been looking at the relationship between cap rates and pricing and growth rates for the last 10 years, and we concluded that the best risk-adjusted return were in these markets. We've proven to be right. That's one of the reasons we've outperformed others, is the market selection was correct when we were making those decisions. We also, I mentioned Tom works out of our Denver office and lives in Denver. That's also true of our Dallas office. We have an office there where our team is living and working. We have a Charlotte office and we have a Nashville office. And so throughout these markets, we have local presence with our acquisition teams living and working in their markets. Our hub is in Chicago, and that will segue into the next slide, please. So I'm sitting in Chicago. We have roughly 35 to 40 professionals at Origin. We are hiring more right now in analysis and data analytics. The hub is Chicago. This is where all of our analysts are. It's where our accounting teams are, our marketing teams, our investor relation teams, our general counsel, and our data scientists. They're all here. And I would say that's roughly 25 people. And then the rest are throughout all of our markets. So I'm going to focus here on Origin Multilytics. That's our data scientists. They're here in Chicago. We had a pain point about 2 years ago. We didn't feel that any of the solutions provided for rent growth were sufficient. They're market leaders in that space. You license their software, pay for it. We didn't think it was particularly helpful. And so we built our own, and we've been working on it for 2 years. We are now in the process of getting a patent for it, trademarks, trademark secrets. We believe we have something much better than what's in the market. Currently, we don't do anything with it other than make, I believe, better decisions here, because now we're pairing 2.7 billion unique data points monthly in a machine learning tool that's completely unbiased with the people that live in our markets who have the relationships and the knowledge. And I think the summation of those two things yields really good decision making. And by the way, that's throughout the life. It's not just about buying the asset, but it's about hold sell analysis. When do you sell? Why? We're always looking at assets in the life cycle of this and trying to make the best decision for our investment partners. I did not spend much time on this. Again, we'll do whole webinars on it, but I'm over and I don't want to make that mistake again. Tom, take it away.
I got this. Thank you, Dave. And for those of you who have sent questions in, thank you. If there are other questions out there, I'm going to sprint through the deal pipeline so we make sure we have time to answer everybody's questions, but keep them coming. We will get to them at the end. As Dave mentioned, I'm going to jump through our pipeline and some individual deals here quickly. This snapshot is really our current development pipeline for this fund, so for Growth Fund 4. And really, this is a top of funnel view. So this is the deals that we're currently looking at, evaluating, underwriting. This $1.3 billion of deals is really 18 deals across 14 of our markets. Not all these deals will hit. In fact, most of these deals won't hit. I think if we're lucky, 2 or 3 of these deals will become part of the fund. But that's important to note that these are constantly churning through the system. We're always looking at more opportunities. We're always digging into new micro markets and that sort of thing. And so this, although is $1.3 billion, we will hit a couple of these, and then there will be next week another $1 billion to look at as well. And what's interesting about this is the breadth and the depth, both from a geographic perspective as well as a count perspective. What this breadth allows us to do in conjunction with our market knowledge is select the best deals in every single market, and not only in every single market, but across all of our markets. When we meet for investment committee every week, we talk about deals in Phoenix and Salt Lake and Denver and Dallas and Nashville and Atlanta, and we compare the deals across markets, and that allows us to select the best deals that are in every single market and available to us at each point in time. This $1.3 billion is, again, something that churns through every week, every month, and only the most select make it through. And the question that I've gotten before is, how do you see so much deal volume? How is it that it's possible to see $1.3 billion and knowing that most of these opportunities won't hit? And the answer is what Dave mentioned earlier. We've been developing for more than a decade at Origin, and it takes a long time to build the relationships for this development pipeline. The vast majority of these opportunities are with partners that we've known for years, many of whom we've executed not 1 or 2, but 6, 7, 8 deals with. And you'll see that when I walk through the individual deals, that really what we've done that the investor benefits from here is relationship building. And that is a big piece for risk reduction. As Dave mentioned earlier, a big piece of what we have to do is mitigate risks. And it's not just interest rate risk, there's nuanced risk to every single deal. And once you mitigate something like interest rates, the other thing you have to mitigate is partnership risk. And by working for years to find the right partners in every market and then growing with those partners, not just, again, 1 deal, but 5 deals, 8 deals, 10 deals with the same partner, you know what their hot buttons are, they know what your hot buttons are, and you make sure that you have a strong working relationship together. And that's really the benefit that 10, 12, 14 years as a firm brings to the table for this fund and these fund investors, is that reduction in risk through those years of relationship building. So with that, let's move on to individual deals. The deals that we're going to talk about here are those which have a very high probability of being part of the fund. At any point in time, something can go sideways, but many of these deals we've closed on the land on. These are existing partnerships, so the risk of these not being part of the fund is very low. And so we'll talk about them on a deal by deal. There's 5 to go through. In the investors who are contemplating this fund or have already committed to the fund should feel free to ask questions about these deals, because they're ones that, again, we've been working on for 12 to 18 months. And what's interesting about that, as Dave mentioned earlier too, is we put these under control 12 to 18 months ago. And if you think about that, 12 to 18 months ago was end of 2020 or early 2021, and that was the heart of COVID. And what that means is the land basis on most of these deals are COVID pricing land bases. The value of the land, since we've put these under control and start working on them, is up in some cases 20, 30, 40%, but in other cases 3 or 4 times where we have these under contract. So they're deeply, deeply in the money. And what's important about that is Fund 4 investors, Growth Fund 4 investors will not pay a markup on that. So our land basis from 20 and 21 and early 22 will also be your land basis when you invest in this fund. We will not take any benefit from the work that's been done to this point, both whether it's a capital markets benefit or through entitlement and design process. So I think that's an important piece to touch on. This first deal here is Star Ranch, Preserve It Star Ranch, which is our 4th deal, I believe, with our partner. There will be several deals in this fund with this partnership. This is a BFR, build for rent project in suburban Austin. Build for rent, I want to take a minute about this because this is a little bit newer of a concept in the real estate community, but certainly in the non-real estate community. This is a very unique concept. The idea here is that you're not building a 3-story apartment complex that most folks are accustomed to walking to and renting. This is building single-family homes that people can rent as a single family home, but you're building 300 plus of them at a time. What's in that generally results in higher rents per unit, because the resident has this feel of a home. They have a backyard. They have the ability to walk into their front door and say, hi, honey, I'm home type, as opposed to being an apartment community, which will save a little bit of money. It's a 3-story. It's a lot of bread and butter of what we do. But this BFR product is a really quickly growing segment in the real estate community. And it's very hard to put these under control and to build with scale. This particular opportunity is 310 units, which is a huge unit count for a BFR product and will be highly sought after if we decide to sell at some point down the road, because it's hard to get those efficiencies and scales. And this is a credit to our partner on this deal, who was able to put together 6 different residential parcels that we closed on in Q3 of 2021 and put them together so that we can have enough scale to build a high unit count project. Again, this is in Northeast Austin, a submarket called Pflugerville. And if those who know Pflugerville know the value of that name. It's got tremendous access to jobs, whether you're going to the Domain, a 15-minute drive, a 5-minute drive to the Dell campus, or a 10-minute drive down to downtown Austin. This has tremendous access to jobs at a fraction of the cost of home ownership, but you get that same feel. It also has great access to recreation, as well as Pflugerville schools. The schools in the area are outstanding. I would expect a number of young families to move into this project when it's completed. This will break ground sometime this summer. We're working through the design process right now, and we should be in a position to break ground in late Q2 or early Q3. Jeff, let's move on to the next one. Haven at Apache. This is more of a traditional product that we're accustomed to seeing. It'll be part 4-story and part 5-story wrap product in Tempe. And the thing I'd really like to focus on this deal is the fact that it is in Tempe. I love Arizona as a market, and I really love Tempe as a market. It's anchored by Arizona State, which has 100,000 students at it. And most importantly, Arizona State has done a really nice job since the current president took over about 2009 or 10 of driving institutional, meaning S&P 500 type companies to the Tempe market. They've done a really nice job. The school has done a nice job of saying, hey, Mr. Fortune 500 CEO, what kind of employee are you looking to build your company with? We'll create a program that tailors to your needs. And in exchange, you're going to move a regional or corporate headquarters to the Tempe market. As such, State Farm, Carvana, Live Nation, a number of Fortune 500 companies have all relocated or started new headquarters in the Tempe micro market. And it's really become an epicenter for job growth, not just for Tempe, but for the entire Phoenix MSA as a whole. So this is the epicenter of job and population growth. And our site is in the heart of all of that, in that path of growth. And it's right on top of a light rail station too. So I think there's a lot to really like about the Tempe micro market, as well as this particular site. And we'll break ground on this similar time frame. Late summer, mid to late summer will be a groundbreaking. The land closing on this occurs here in the next, we'll call it 30 to 45 days. And it should be a really exciting project to get going on. Let's move on to the next one, which is Solace at the Ranch. This is truly bread and butter garden product for Origin. This is one that we've executed thousands and thousands of units on in the past. But what's unique about this 3-story garden product is that it's in Colorado Springs. It has a very strong partnership, as I mentioned. It's something that we spent a lot of time with. This partner is their 3rd deal in Colorado Springs, but the first with us. And they're extremely well capitalized, extremely well knowledgeable about the project. It's a group that we've been talking to for years, and we're thrilled to be breaking ground with them. Equally as important is the fact that it's in Colorado Springs. This is a market that I had my eye on since I moved out to Denver years ago, and I've always really had a tough time getting into the market. And this will be our now 4th deal in that market. And the reason I like is it's so dynamic. It's been Denver's, call it little brother, if you will, for the last really forever. And it's just starting to get its time in the sun today. The politicians have become substantially more pro-growth for the market. It is now a lower cost alternative to Denver. And it has the same, or even in some cases, better access to the recreation, which is why a lot of folks are out here in Denver to begin with, is for that work-life balance. imagine having that same balance, but paying 15, 20, 25% less in Colorado Springs than you would in Denver. But yet having the same access to jobs, same access to the ski resorts, to the hiking and the biking. What's also unique about Colorado Springs, as I mentioned, this is our fourth deal there. I'm optimistic that we'll put several more in the market, but this is a top 5 pick from our AI platform that Dave mentioned. So over the next 5 years, what that means is based on the data coming out of Colorado Springs, those 2.7 billion pieces of data every month, based on that data compared to the 170 plus markets that we compare it against throughout the country, Colorado Springs is considered to be one of the top 5 markets in the country over the next 5 years from a rent growth perspective. So we believe that we have very strong tailwinds in this market. It's one that we're extremely excited about to go deeper into and to really have that deep market knowledge. And then, of course, starting this relationship with this partner that we've been cultivating for years and finally have an opportunity to move forward with them. Let's move on to Haven at Cool Springs. The unique part about Haven at Cool Springs is that it's a very high barrier to entry and very high demographic market. This is in South suburban Nashville, which is, again, a market that we've moved into a handful of years ago. And generally speaking, high barrier to entry and high demographics go hand in hand, and this is no exception. So in order to get into this potential development opportunity, we started working this deal just like all the others 12 to 18 months ago. We'll close on this land in the next 30 days, and we'll be looking to break ground shortly thereafter, let's say the next 60 days thereafter. And it's one of those opportunities that the actual setting itself of the real estate, not only is it so hard to build, but it's very hard to build in a site that's as good as this one. It's a unique sitting on top of a hill, overlooking a golf course, a very serene setting when you're looking at the north side of the project. But when you go out the south side of the project, you're walkable to all the retail amenities that you could possibly want: the grocery store, the quick serve restaurants, the sit down restaurants. So it's got a very unique blend of serene, golf course views, settings, and relaxation, combined with all the access to retail that any potential renter could want. I think it's going to do exceptionally well, especially considering how challenging it is to build in the Cool Springs Franklin market. So let's go on to the last opportunity here and trying to keep it on time. Haven at Lloyd Park. This is the newest addition to the list. If you happen to watch our Growth Fund 4 webinar a month and a half ago or whatever that was, this was not yet on the list. This is part of our programmatic venture with Geffen, as a couple of the other deals represented here today are. This represents, I believe, our 8th deal with them. The reason this is a unique opportunity for us, it is, again, like the Colorado Springs opportunity. This is 3- and 4-story garden product. It's the bread and butter of what we do. It's the bread and butter of what Geffen does. But most importantly, it's located in southwest suburban Dallas, in the Grand Prairie submarket, and which provides fantastic access to both the Fort Worth and the Dallas metro from a job perspective. So I like to call it mutually inconvenient for your spouse and you, or your partner, or whatever that might be, where you can't decide if you want to be in Dallas or you want to be in Fort Worth. This is a nice opportunity to have a mutually convenient or inconvenient commute to both submarkets. The demographics are off the chart here, which means the folks can easily afford the product that we're going to build and develop here. It's one that will probably change from a design perspective several times before we actually break ground, which will be Q3, Q4 in 2022. But it's one that we're very excited about. And I think will fit the bucket very well. So that was not quite 15 minutes, Dave. I'll pass it over to you to talk about the fund.
Nice job, Tom. That's great. All right, so I'll do the summary terms and then we'll go right into the Q&A, and we'll have, I hope, 20 minutes. So I'm just going to go straight down here. Our co-investment, I mentioned before, is $5 million. The target fund size, $200 million with a $250 million cap. We've had a lot of questions about potential sidecars from investors who have done sidecars with the Income Plus Fund. The answer to any sidecars is we don't know, but if there are sidecars, it will be given preference to people in this fund. So that's an added benefit if we do have them. The initial closing, March 31st, 2022, which is essentially in 6 weeks. Is that right? No. Yeah, that's right. March 31st. Final closing 12 months after the initial closing. So that's essentially a year after that. I don't think we'll be raising that long. Based on what we raised in January, we'd be through the raise in 8 months. I know it's not linear, but that's the pace we're on at this point. The capital call period, now that's the period we can call capital, and that commences on the initial closing date and extends 24 months from that initial closing date. We don't expect that it's going to take that long to call capital in this fund, again, because we've been working so long on the deal pipeline. And Tom covered 5 of those deals, but the reality is there's a really large deal pipeline even behind that. So I don't think it'll take 24 months. If you're planning for your capital allocation, I would plan for it to happen quicker. The development period is 48 months, and that period is both the construction period, but then also the lease up period. So we have to build it, then we have to lease it, and at that point we can refinance it to a fixed term lender. People in the fund get a return of capital and profits potentially from the refinance. If we build value, then that will provide that liquidity, and that will coincide with your decision, your option, if you will. Do you want to get out completely, or do you want to get out after the optional hold period? That's up to the particular investor, and that's after that 48-month period. We had a bunch of questions about cash flow, so let me just be clear. When we're building and developing during that 48-month period, there won't be any cash flow because we don't have renters who are paying rent. Once we fully rent, obviously then there is cash flow, and you can expect the cash flows to start at about month 48. So if you were only to be in the development period and then not accept the option to stay in for the whole period, you wouldn't receive cash flow from operations. You would only receive the margin that we're developing. On most of these deals, the margin is anywhere from 30 to 35%. So anytime you look at a deal, and Tom just did a deal that was 300 units, it's pretty easy math. I mean, you're talking about 300 units. The margin on every unit's about 100,000. We build them from 250 to 350, and they tend to sell. If it's 250, they tend to sell at 350. If it's 350, they tend to sell 450 to 500. That's the math. So as an investor, you can kind of look at that. That would be the gross return. So in terms of the management fee, so this is a little bit of a two-part answer. Our management fee is 1.5% on equity per year, unless you are an existing investor and you invest by March 31st. So if you invest by March 31st and you're an existing Origin client, you get a 1.25% management fee only for the next six weeks. This is our way of thanking our existing investors who've been partners sometimes for 10 years, 12 years, 8 years. So that's a benefit to them. However, if we have larger investors too, some of our family office clients likely will invest more than 5 million. And if they do, they also receive the 1.25. And so that's the break point. If you're a non-client, under 5 million, it's 1.5. If you are a client, it's 1.25, but you need to do it by March 31st. It's not out there indefinitely. The committed capital fee, this is pretty important. There is none. And so what we've done is we've said, okay, we're not going to charge anyone a committed fee. What we're going to do instead is charge a 50 basis point one-time fee as we close on deals and capitalize them. And so when a development is ready to have equity and debt invested into it to start construction, that's when that fee will be charged. And it's not different, it's better for you. That's why we did it. A committed capital fee means you're paying us to go look around and find deals. And we may or may not find them. We've always found them, but there's a risk that we wouldn't. In this case, we collect no management fee until we actually find the deal, and then it comes in the form of an acquisition fee, which is very, very similar in total revenue than committed capital fee. It's just we're taking the risk. you're not. And then performance fee, it's a 15% promote once we've provided an 8% for return to you with a 50-50 catch up. And I had a question about 50-50 catch up. The easiest way to think about a 50-50 catch up is Origin, if we do our job, will take 15% of all the profits. And that's what the catch up provides. And the investor will take 85% of all the profits. If we didn't have a catch up, that math wouldn't work. That's why catch ups, you see them in all private equity funds. It's to make sure that the revenue split, the profit split is 15-85. The other thing I would say about the performance fee is we're below market and we know it, right? So I'll tell you right now, every competitor in the market is 20%. And some are higher, some are 25, I've seen 30. We don't want to gouge investors. We're charging a 15% performance fee, but make no mistake, we're also the best at what we do. We're not charging less because we don't have pricing power, we do. We've just decided that 15% is what we're going to do for this fund. We'll reassess in the future. We're below market, and that's another benefit to you. I think the benefit is two-sided. We're better than others at what we do. The data proves it. We also charge less than our competitors. All right, so with that, I'm going to kick off questions. And we have 13 minutes, and we were both rushed. So Tom, I'm going to answer the first one. I'll ask all of them. Melanie, thank you for your question. She has actually an opportunity zone question. We have 2 opportunity zone funds. One of them is fully invested and not raising, the other is. Melanie, please email me offline, David@Origin Investments. I'm happy to answer all your questions or refer you to our investment relations teams. We have 10 people on that team as well. Okay, so Jeffrey, thank you for your question. He had a question about, and I'll answer this one too, Tom, but I promise I won't answer them all. He had a question about the fact that we have 4 funds right now that are active funds. This question is, are you stretching your team too thin, and how are you losing focus? That's a specific question. And Jeffrey, my answer to that is, it's actually the opposite, that all of the funds benefit from each other. And so the reason we're so prolific, and we're, in my opinion, among the best of what we do, is we have different buckets of capital that are accretive to the other, right? So for example, why do we have such a big net in terms of Growth Fund 4 market rate development deals? It's because QOZ2 and QOZ1 were sourcing development deals for the past 3 or 4 years in qualified opportunity zones, and we've built all these relationships in those ecosystems we can leverage. But we also did it in Income Plus Fund. And so it really is a game of addition. I view it completely differently. This fund benefits from the fact that we do have other funds which make us extraordinarily active in the development ecosystem. We're probably one of the top 3 to 5 most active developers in the US right now in multifamily. And that breeds more quality deal flow. I was looking at a competitor, I won't name them, a deal in Charlotte yesterday. And I emailed Dave Welk, who runs our Charlotte office and our Southeastern operations. And I said, did we see this deal? And he said, yeah, we saw the deal. And he forwarded me the email. We underwrote the deal a year ago. We passed on the deal. There were a lot of reasons. It was on a ground lease, which is essentially more leverage. And the returns are thin. So the risk was high, the returns were thin, we passed. So in other words, we were first look. We looked at it a year ago, we passed. We did other deals. It winds up in our competitors, one of them, a year later picked over. Like that's what you don't see as an investor, and what you're trying to avoid. And I would tell you that our activity in all funds is accretive to this fund, is my answer to that. And then the second answer is, we always hire ahead of growth, always. We have 40 people that work at Origin. Well, none of our competitors have half that many. Why? Because we want to deliver the best returns, but also the best service. Haven't talked a lot about service, but from the time that you become a client and the onboarding to the reporting to the webinars, we want you to feel like you're a partner that knows everything they need to know. And if you have questions, we're responsive and requests, but that only comes with a quality team, and we invest ahead to make sure that happens. All right, I'm going to move on. Tom, here's a market rate question. It's anonymous. Does the projected population growth in the US, coupled with a surge of capital raised in real estate funds, give you concern about the fund in the long term?
It's a good question. It's kind of a two-part answer. The first, and this specifically addresses Southeast multifamily, but I'll address it more broadly as a US, because one of the things that we come across, especially when we talk about the competitive set, is why are certain groups still doing what they're doing? They don't have the nimbleness to move across markets. They don't have the nimbleness to move across different portions of the capital stack. They don't have the nimbleness that Origin does to maximize returns with the opportunity set that's presented itself at any given point in time. That's why we focused on multifamily to begin with, is so we can go an inch wide and a mile deep. We can play across preferred equity, joint venture equity, co-GP equity. This allows Origin as a firm to maximize the returns regardless of the conditions across the real estate spectrum. The second piece to that is we have invested heavily in this multi-analytics tools to help us better predict and see with true data what's going on in the market today. Where are people moving from? Where are they moving to? Because the most important part about real estate is job and population growth. If you want to win in real estate, you don't over-lever and you go to places with job and population growth. The not over-levering is just part of our DNA. We're very astute risk managers. And the second piece is finding that job and population growth. And those two pieces combined will allow us to outperform for the long term throughout all market cycles across all of our target markets.
Question from Michael. I always only use the first name. Does Origin hedge raw material costs? No, we don't. But what we do is we're extraordinarily conservative at every given point in time with contingencies. And so even with the volatility this year, and it's been more volatility than we've ever seen in terms of really all costs, but lumber, trusses, concrete, gypsum, I can keep going. It's been volatile, but to our underwriting, when we're underwriting a deal and all of the contingencies and cushion we put in, we've come out about flat. Certain deals actually came in under, certain came in over. And then of course, if we underwrite a deal and lumber's at 800 a board foot, and then we go to break ground, it's at 950 a board foot, that would be a deal where we might be a little over, but then it also goes the other way. Lumber's been as low as 600 this year. So the short answer is no, we don't hedge, but we're extraordinarily conservative, and the margins are so big that we can be. So when we're looking at a deal and we're saying, okay, these are the rents, this is the cap rate, we do a lot of things in a model to make them quite conservative. For example, I'll just give you a very recent example. Tom is sourcing deals in Phoenix. That's one of his markets. And the spot cap rate, in other words, where tax adjusted these transactions are happening, is anywhere from 3.2 to 3.5. I mean, I think he would tell you that's kind of where it is. There's some outliers. I saw one at 3.1. Sometimes they might. I don't think they ever really get above 3.5, but we don't even start a cap rate below 3.75. We just won't. And so in a model, like, I understand the cap rate's 3.1 to 3.5. I just won't do it. And so number one, we're starting our models. It's a very important metric because it's your multiple on earnings metric. We're starting it well above the market, and then we drifted 2% a year. So over 4 years, that's building in almost 10% more cushion on top of that. So when we're exiting Tom's deals to our models, we're exiting at a 4.2 when it's kind of trading 3.3, 3.4, 3.5. So if we started seeing cap rates go up, we would get calls maybe from investors saying, oh my God, cap rates are going up. But the reality is they have to go up a lot before they get to our underwriting, right? That's one of the ways that we mitigate risk. The other way we mitigate risk is typically construction contingencies were, 3 to 5%, and maybe another 2 to 4% at the developer level. We've doubled them, right? So and the deal has to withstand that extra cost and still pencil to a 30 to 35 margin. And the interesting thing is they do. I mean, I didn't really cover this before, but this is the highest margin I've ever seen in 12 years in real estate is right now. It might be because people are afraid of what they perceive as risk, but our job is to mitigate risk, right? That's why we're in this to start with. Whether that's interest rate risk, construction risk, input cost risk, execution risk, partner risk, they're all there to be mitigated. All right, next question. Is the optional hold period, I'll answer this, Tom, the cash flow in the optional hold period, is it calculated on original equity? The answer is yes. So if you put in $1 million a year, we're calculating that in the optional period as the $1 million you put in. That doesn't change. When does this fund close to new investors? The answer to that is it depends. It depends how fast we raise it. The longest we'll be raising is about 1.5 years. My guess is we will fill what we need in this fund by the end of this year. That's what I believe will happen. And we'll keep you updated on that. We'll have another webinar and we'll let you know where we are. We're on pace to do it by the end of the year right now. I think I answered all the live questions. I just want to make sure. Oh, Tom, I apologize, but there's a lot of transactional questions here. I saw a management fee of 1.25% on committed capital. Please explain. Thank you for your question, Max. That's not correct. I don't know where you saw it. If it was on any materials, please send it to me because it's not correct. We don't have a committed capital fee. I covered that. It's 0%. Instead, we have a 50 basis point acquisition fee that's one time. Again, that's not different. It's better for you. It's essentially a similar fee, but all the risk is on Origin to deliver the investment to you rather than you paying us to look. So there is no committed capital fee. So please let me know if you have something from Origin that states that, and I'll make sure it's removed. Okay, so I'm going to go to, we have a few minutes left. I'm going to go to the emailed in questions. And Tom, I'm going to put you on the spot a couple of times. Tom, do you want to expand at all on our interest rate, risk management, supply chain, inflation, input costs? I know I talked about that a bit. Is there anything you wanted to add to that?
I think it's important to note too, we see a lot of models, and I'm talking specifically to interest rates now. We see a lot of models, whether it's from new sponsors who don't necessarily understand how we look at the world, or from different brokers who are bringing us opportunities with a flat, often understated interest expense. I would say almost every deal we've underwritten, we assume higher interest rate costs than what the sponsor and or the broker are suggesting would be in place. And that's really a function of being totally in tune with the interest rate markets. As I mentioned earlier, we meet every week to talk about deal opportunities and deal flow. And that includes not just what are the opportunities that we're seeing, but what are we executing on? So what type of debt was executed on the last Nashville deal, on the last Jacksonville deal, on the last Dallas deal, on the last Phoenix deal? And we apply that knowledge to our underwriting going forward in Colorado Springs, in Denver, in Salt Lake City. And a lot of that is having your finger on the pulse of where the spreads are today on interest rates. And the other component to that is understanding where the LIBOR curve, a lot of the debt is based on the floating rate index, as Dave mentioned earlier, which is moving to SOFR, so either LIBOR or SOFR going forward. And every time we touch a model, we update that SOFR curve. And so when we see a shock to the market, like it's, and I wouldn't say it's a true shock, but we see movement in the capital markets like we've seen really in the last 60 days, 90 days, as the Fed has talked about increasing interest rates. The 10-year has gone up 40 basis points, call it 25, 30% over that period of time. Every model we have, every deal we're underwriting takes that increase in interest rate expense into consideration. So what used to be a 20 basis points starting SOFR rate going to 50 basis points is now 65 basis points today, going to 150 basis points in 3 years from now. So all of that is taken into consideration as we dig into each of these new opportunities, as well as updating our opportunities on existing deals moving forward.
Thanks, Tom. All right, we had a question in the chat from Jennifer, and then she also went into the Q&A and asked me to answer it. So thank you, Jennifer. She wants me to walk through a $100,000 investment in this fund and kind of take it through the life cycle. It's a great question. Yes, if you invest $100,000 in the fund, the way it would work is there's no cash flow during development. But if you opted to just leave the fund after 48 months, you could expect $170,000 to $180,000 back. That's what a net return means, and a net multiple means. That equates to a 14 to 16% net IRR for you. If you exercise your option to stay in the fund, you'll receive a return of cash flow from refinance, but you'll also be receiving that dividend payment, which is 7 to 9%, because now we're collecting rents for that optional period. And then at the end of that period, we'll sell, and the summation of those two things, you wouldn't be receiving 170 to 180,000, but now the 100,000 will grow by that additional amount over the next period of time. So in layman's terms, I believe that if you stay in the optional period, you're probably going to wind up with another 0.7, 0.8 to the multiple. So it's not 170 to 180, it winds up being 250,000 in all in, both through cash flow and appreciation. So now you're talking about a much higher return on investment, and also you're not going to be paying taxes from the dividends. Your money's at work the whole time. So there's some benefits to that. If I wasn't clear, that's my fault, and you should please email me and we can correspond directly as well. Thanks, Jennifer. Okay, I think I answered Christian your question too. You had a question about cash flow after development. Yes, once we build the buildings, if you elect to stay in the fund, you'll be receiving the dividend from the rents in the optional hold period. So that I believe answers that. Someone had a question about the right type of capital to invest. So in some of our funds, so in other words, should you invest capital from an IRA, or should you invest capital that's not as tax efficient? You would benefit if you have an IRA. That would be a great place to invest in this fund, because you will have a capital gain at some point, whether it's after the development period if you leave the fund, or after the optional hold period. So an IRA would be more tax efficient than not, but this is a fairly tax efficient fund anyway, because it's a long hold period if you elect to stay in, and there's depreciation and interest expense in the cash flowing years. So I would say this is an interesting fund. It's better to invest in an IRA than not, but you can feel really good about investing just regular capital. That's what I'll be investing into this fund. Here's an interesting question. Without a committed capital fee, how are you able to pay 40 team members? How are they compensated? How does it work? The answer is that this is another benefit to you, that we're a large company with lots of revenue from other funds. We're able to do that. Typically, a manager will charge a committed fee because they have to keep the lights on. That's why I keep saying it's not different, it's worse for you. You're essentially funding their growth and their business if they're a one fund manager, first time manager, those types of things. Tom, do you have anything you would add to that?
No, I think you're exactly right. We've got, to the extent that we've got 4 active funds and 2 that are less active and winding down, the revenue from those is what goes to cover everybody's salaries. And I think to Dave's point, it's an outstanding opportunity, and one of the benefits of investing with an established fund that still offers very fair and, as Dave noted, below market fees.
So Ross asked a question. Thanks, Ross. Who should they contact if they're interested in investing in Growth Fund 4? We have an incredible investor relations team. There's over 10 people on the team, incredibly responsive. There's a lot of different ways you can do it, but you can email us and we'll get back to you. You can call us. You can contact us via the website. If you go on our website, there are pop-ups where you can immediately access investor relations professional. I would be very surprised if you're not working with someone if you contact us in any of those means that day, because we have enough infrastructure and people to handle that. But thanks for your question, Ross. I believe that's it, Tom, unless you want to add anything.
One more in the chat that says, how does the income fund work with this fund?
Yeah, these are separate funds. So the Income Plus Fund, that's what they mean by that, is another product that Origin has. It's a multi-strategy fund. It does both investing in core assets, meaning build stabilized buildings. It develops to hold. We call it build to core. That's kind of similar to this fund, actually, but it only does 20% of that there. And it also issues preferred equity, which is a more protected, it sits above common equity, but gets less of a return because it's a little bit less risky. So that's a lower return strategy than Growth Fund 4. That's targeting 9 to 11% returns, long-term hold. This is more like 14 to 16. And then if you opt in, it starts to feel a little bit like Income Plus in the optional period, but not the development period when the returns are quite a bit higher. So the short answer is it doesn't work with that fund. They're separate products with separate risk return profiles.
And the last one, which I think just came in, is pref compounded during the development period. And then we can
go ahead.
No,
I think you know the answer.
The short answer is yes. Yes, it is. From the day that capital is called, that preferred return begins to tick in the benefit of the investor, and it compounds throughout the entire period. So the answer is yes.
So we really did try to answer all your questions, both through the presentation and I'll answer one more. I know this was emailed in. I had a question about K1s and do we do, because we're in so many different states, are you going to get a tax return from all these states? And the answer is no. You will elect to do a composite tax return. You'll receive one K1 that's a roll up. So it's very simple. We've been doing this a long time. K1s are a pain point. We make sure that we get them out on time so that you can do your tax returns, by April, which is, when we make sure that we have our stuff back to you. So any questions that weren't answered, again, my email, David@Origin Investments, or just feedback. If there are things that you want to cover that weren't, or that you just want to say that, Tom did a heck of a job. I appreciate any feedback or any questions. I appreciate your time. And Tom, thank you for joining us.
Thank you.
Have a good day, everyone.